All right, everybody. Thank you for joining Lark's 2Q or June 2023 webinar. For those of you that don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting. And before we get started, I just want to highlight a couple of things to everybody. First of all, the webinar is being recorded. So if you have to jump off for one reason or another, we'll have it posted on Lark's website under the press releases and webinars section tomorrow at some point. And we will try to send this out to everybody that registered as well tomorrow. We're also going to share the slides with everybody that attends. So you don't need to ask if we're going to send the slides out. We will send the slides out. I know somebody's going to ask. Okay, but those of you that are here now and paying attention know that you don't have to ask. And then the third thing that I would highlight is that we will have some time for Q&A at the end of the presentation. Happy to answer as many questions as we can. If for some reason you either don't want to ask a question or you have to log off before we're able to answer a question, feel free to shoot us an email. My email address is ryan.melliker@larkanalytics, LARC analytics.com, or you can always just try information at Lark Analytics as well. Both work, and we will respond to you as quickly as we can. That being said, we're going to go ahead and get started. We got a lot to cover today, so we're going to jump right in. We are going to walk through a review of the U.S. market. We'll talk about the cycle a little bit. We're going to spend a good bit of time on the economic outlook driving our hotel forecast, and then we'll dig into our forecast on the top line as well as the bottom line and values, followed by an overview of the market highlights. And then we're going to walk through a little bit of kind of drilling down from the market level to the location specific level with you guys. That being said, let's jump in. So our U.S. market review, what I will tell you is that the recovery continues to progress relatively nicely. If you think about where we are and you're looking at things relative to pre-pandemic levels, what you see right here, ADR and RevPAR are generally ticking up, though we saw a little bit of a pullback relative to 2019 levels in April. But what's interesting is occupancy continues to struggle to get back to 2019 levels. And over the past few months, we've actually seen a slight deceleration trend relative to 2019 levels, which arguably is a little concerning in terms of occupancy recovering to get back there. And we'll talk about that in a little bit. When you think about things at the market level, we're just going to talk about 2022 here versus 2019 because it kind of frames the backdrop of our outlook for the markets. There are haves and have-nots. As everybody on this slide, everybody on the webinar already knows, we've got plenty of haves and have-nots when it comes to market exposure and which markets are performing well and which ones aren't. But what's really interesting is, a lot of the markets that were performing really strongly at the start of the pandemic are some of the markets that now have the toughest comps and aren't performing as well, whereas some of the markets that were performing really weakly, at the start of the recovery are now the ones performing strongest because they're off of the very low base. So to give you an idea, 34 of Lark's 49 markets that we cover on a quarterly basis had positive RevPAR relative to 2019 last year. That was up from 8 a year earlier, but the market divergence was extreme, as I just mentioned. If you look at ADR specifically, again, 34 of Lark's 49 markets were positive. Market divergence remains extreme. You had markets like Palm Beach up over 35% relative to 2019, while you had markets like San Jose and San Francisco that were still down double digits relative to 2019 on nominal ADRs. Just something to keep in mind. When we think about what's going on across the market today, air traffic has really, fully recovered, which is kind of interesting. As of late 2022, the air traffic recovery had taken a step forward, and basically, we're roughly on par with 2019 levels. Over the past couple of months, we've been roughly on par with 2019 air traffic volumes on a 30-day moving average. That's pretty encouraging. There's obviously some bumps along the road, usually tied to holidays and things like that. But generally speaking, things have looked particularly good. It just isn't necessarily showing up right now in occupancy that's also relative, comparable to 2019 levels that I talked about earlier. Um, Hotel booking volumes. If you look at this top chart here, the lower line and lighter colored line is the US and the upper one is global. And what you see basically is that US booking volumes throughout February 2023 were approaching 2019 levels. However, then they started to kind of pull back, and they've now kind of plateaued in that 85 to 90% of 2019 levels. We'll talk about what that means and what was driving that and what we think may have happened there in a little bit. But the good news is there's been some relative stability in booking volumes over the past couple of months. We're not seeing a continued downward trend. And booking windows appear to be lengthening a little bit, as you see in the bottom chart. And that's all data from SiteMinder. Let's talk about how this cycle is a little different. This is the occupancy recovery of this cycle versus past cycles. The solid dark blue line is the current downturn, not surprising, much deeper than the others, followed by a quick recovery. But what you're seeing now is basically we're kind of moving along at a similar pace over the past couple of years as prior cycles in terms of occupancy recovery. And this is all trailing 12-month data, so it's a little bit smoother. Following 9/11, it took 65 months to get back to prior peak occupancy. Following the great financial crisis, it took 81 months. It's been 47 months as of April. We're still on a trailing 12-month basis, 4.2% below prior peak. We don't have a high degree of confidence that we actually get back to prior peak, but we'll talk about that in a little bit. Just kind of an interesting chart to look at, that things have really leveled off from an occupancy perspective. ADR is a much stronger chart, right? That V, went down hard, came back just as hard. Things have started to slow a little bit, but you still have, on a trailing 12-month basis, pretty strong ADR growth, way above kind of what we've seen in terms of past recoveries. And this is nominal, so inflation has an impact, don't get me wrong, but it's still pretty encouraging data. On a trailing 12-month basis, this cycle, we got back to prior peak ADR in March of 2022, which was month 25. Compare that to after 9/11, it took 45 months. And after the great financial crisis, it took 52 months. So about twice as fast. Put the two together and you get our RevPAR. RevPAR also has been faster. And the RevPAR trajectory is a combination of the ADR and occupancy. It was month 38 that RevPAR got back to prior peak. We're now close to 12% above prior peak on a trailing 12-month basis as of April, that is. We got there in month 29, and following 9/11, it was 52 months. It took 52 months, and following the great financial crisis, it took 59 months. So not quite twice as fast like ADR, but substantially quicker than what we've seen in past cycles to get back on a nominal basis. When you think about values, a couple things I'll highlight about hotel values is following the great financial crisis, values dropped 27% from the peak 2007 peak to the 2009 trough. They then didn't get back to that prior peak level until 2015, 8 years after the prior peak. In 2018, though, 3 years after that, they were 18% above 2007 peak. So there was just massive recovery over the course of that cycle. And we can argue as to why that was the case, but there was really strong value appreciation. Values this cycle began declining prior to the pandemic in 2019. We estimate that, in a fully transparent environment, values would drop about 23% in 2020. Then they started to recover in 2021, continued in 2022 slightly, and they were just slightly below 2019 levels by the end of last year. We'll talk about where we think they're going to go in a few minutes. But bottom line is, it's just kind of interesting to see how fast does that strength of the recovery during the last cycle in values. We don't have quite that same positive view, despite the fact that the view on fundamentals on a nominal basis is particularly strong. We'll talk about that as well. As we shift to the economic outlook, which I think is something really important that we want to spend some time on, there's a lot of things, there's a lot of moving pieces here, and I'm going to try to bifurcate this as best I can between the different demand segments and factors that are really driving our outlook. But one of the things that I think is really important to keep in mind is the return to office, and the slow pace of that return to office. We keep hearing news that companies are making waves and moving back to the office. Farmers Insurance announced they were going back to the office 3 days a week, and there was an employee revolt. It sounded like, according to an article in the Wall Street Journal this week. Bottom line is we're still close to half of office utilization levels that we were at back in 2019, according to Castle Systems. That's not the end all be all data, but it does point to some of the challenges that the industry is facing. If you don't have people in the office, it's going to have an impact on corporate transient demand. Our view on the return to office is that we will never get back to full utilization that we experienced in 2019, or when I say never, not within our 5-year forecast horizon, and hard to know beyond that. So that's going to weigh on corporate transient demand in general, and it's just something to keep in mind. As we think about corporate transient demand, a couple of things that we would highlight is, corporate profits are projected to decline about 5% this year. They're projected to be down again next year. Not a good recipe for corporate transient demand growth, right? But they're still going to be 20% over 2019 levels this year. Stock market has bounced back a little bit. It's up 9% this year after being down almost 20% last year. But it's still almost 30% above 2019 levels. Bottom line is, while we've seen a pullback in some of the primary factors that drive corporate transient demand on a national level, that pullback is off of a level that is well above 2019 levels, while corporate transient demand in general is still well below 2019 levels. So we believe these factors just limit the pace of recovery for corporate transient, as opposed to causing a decline in corporate transient like you might normally expect. If corporate transient was at a normalized level, we would see these factors having a bigger, more likely impact on turning corporate transient demand negative. We don't see that at this lower than normalized level that we've been experiencing recently. Leisure may be a little bit of a different story. One of the things that we really monitor a lot of different factors that drive national leisure demand, from personal savings rates to growth savings rates to personal discretionary income to personal spending, foreign exchange rates. List goes on and on and on. We look at a lot of factors at a national level, and one of the ones that drives our models, or is very relevant, that we pay close attention to, is what we call the U.S. personal savings rate in billions of dollars. And what's fascinating is, coming out of the pandemic, the personal savings rate was basically at an all-time high. And that was fueled by two primary factors. One, people didn't spend any money during the pandemic, and two, fiscal stimulus. So that led to an exorbitant level of pent-up leisure demand that really drove a really strong leisure recovery in 2021 and 2022. However, as you can see, since then, personal savings has been eroded, and that has been driven by people spending more money, cost of living going up, all these factors that weigh on it. Now, we've started to bounce back a little bit recently, but when we're down at these levels, it's hard to imagine that you're going to see the same level of leisure transient spend during this summer season as we've seen over the past couple. And I think you're starting to see that in terms of forward bookings, and especially at the high-end segments. So just something to keep in mind, where we have some reservations regarding leisure. We think that what you saw in 21 and 22 was a little bit of an outliers, really strong leisure demand that was not sustainable. But we do still have relatively positive views of leisure, just not quite that positive. Convention, here's a bright spot for 2023. We track 30 of the largest convention centers across the US. And their 2023 booking pace is up 17% year over year, and just 3% below 2019 levels. Really strong numbers on average. Unfortunately, that's partly driven by a level of pent-up demand as well. You saw a lot of major groups that were booking that had conventions canceled in 2020, 2021, and even early 22 that may not have been annual conventions that then rebooked into 2023, elevating that pace. Unfortunately, then as those roll off, they don't rebook for 2024. And now 2024 is actually pacing down 11% from 2023 on average. So you've got a headwind next year that's worth noting. especially across a lot of convention centers. And and that's just on the major convention center. At the in-house group, things look pretty good as well. So the group segment's definitely recovering more quickly, but we do see a little bit of a challenge in 2024 before growth resumes in 2025. The U.S. Convention Center booking pace is up 5% year over year in 2025. So 2024 is more just a tough comp related to the recovery because 2023 is so strong. Fiscal stimulus, I don't need to spend a lot of time on this, but fiscal stimulus was exorbitant coming out of the pandemic or during the pandemic. And we always knew when you were spending this amount of money during the pandemic to keep the economy afloat, you were kind of borrowing from the future. So, to sustain the present. That's exactly what happened. We're in that future now, and it's having an impact on our economic growth in the form of inflation, in the form of cost of living, in the form of a variety of other factors that we'll touch upon. But it's just something to keep in mind that the fiscal stimulus was going to have an impact in the future. We all knew it then. We're in that future now, so keep that in mind. Inflation, the good news is moderating, and we think it will continue to moderate. And it's not just us. Moody's and the Wall Street Journal consensus economist expectation is that inflation, or CPI, will drop to under 3% by the end of this year. We think that's very encouraging and should lead to positive views related to the Fed, which, as we talk about right here, we think base rates are stabilizing. So our house view is that the Fed is done raising rates this cycle. That doesn't mean to say they are done tightening, but they're done raising rates. We think they're going to shift from a quantitative from raising rates to a quantitative tightening, as opposed to the opposite of quantitative easing, where you'll see them, instead of buying bonds, selling bonds. But we think ultimately the Fed won't be raising rates this cycle. We will see them starting to cut rates at some point in 2024. There's a few reasons for that. But what's important to highlight here in terms of that is, if the Fed's not raising rates anymore, then we should see some stability in base rates. As we see some stability in base rates, we're going to have more stability in debt yields and cost of debt, which should help stabilize cap rates, and transactions should resume some point in the not too distant future. But we need some clarity surrounding the Fed as well. I think right now we're still kind of holding tight. So why do we think the Fed is done raising rates? It's really not that complicated. Unfortunately, it really goes back to everything that has happened since the start of March. Last time we did one of these webinars, a couple weeks after we did one of these webinars, Silicon Valley Bank went under, Signature Bank went under. In total, we've had 3 banks with a total of $532 billion in assets fail over the past 3 months. That's not a small factor. And just to give you guys some perspective on what we're talking about here and what this really means. So commercial banks generally reduce their lending when their deposits fall. If they have fewer assets, their net capital requirements to maintain regulatory standards force them to not deploy as much capital, or potentially even call capital in sometimes, or raise equity, some of those challenges, right? Well, deposits have been declining. They began declining in the middle of last year. The declines peaked in 1Q 2023 related to SVB, but the expectation is that those declines will continue. You're this below zero metric here through the 3rd quarter of this year. As banks are declining, what that does is it translates into tightening of credit conditions. I'm not talking about hotel debt or real estate debt. I'm talking about broader credit. Banks are less inclined to lend money. Their standards for making a loan get much, much tighter. If banks don't lend loans to businesses, businesses can't fund their growth. If businesses can't fund their growth, they don't grow. If businesses don't grow, the economy does not grow. And this is a real concern. We went from, in the middle of last year, banks were loosening their credit standards, as we see here at that negative 1.5% tightening, to now in the 1st quarter, almost half of all banks were tightening. And that's expected to continue. We're going to see more and more continuing to increase their tightening standards. So this is a real concern that's going to have an impact on economic growth over the next couple of years, that is built into our assumptions and built into our analyses. Credit crunches, can really undermine investment in economic growth. If you go back and you look at, the periods where lender tightening exceeded 40%, remember we're north of 40% right now, they basically were all right around recessions, pandemic, great financial crisis, 2001. Oh, goody, that's kind of the challenge that we're facing right now. Are we entering a recession? Are we in a recession? Our view is that is a matter of semantics. Whether we're in a recession or not, or going into one or not, I don't think it matters that much. What matters is that economic growth is going to be anemic over the next couple of years, regardless of whether we get a recession declared or not. Keep in mind, in 2022, first quarter and second quarter had negative GDP growth. That has historically been the indicator for a recession being declared, but a recession was not declared. Again, semantics is really what that comes down to. Moody's outlook for real GDP growth is 1.6% this year and 1.7% next year. To give you some perspective, since 1970, each and every calendar year that had a recession within it, where recession was declared, 43% of those calendar years had actual annual GDP above 1.7%. So Moody's is technically not calling for a recession this year or next year. They don't think one will be declared, but it's semantics. At the end of the day, this is anemic economic growth for a couple of years, and that is likely to weigh on the broader lodging industry, which is something that we want to highlight to people. U.S. unemployment rate will gradually tick up through late 24. We expect it to stabilize, still at a pretty low level at 4.2%. Inflation, as we talked about, will moderate. And as we talked about, interest rates are stabilizing, which is encouraging. Whether there's a recession or not, again, I think it's semantics, but these are the kind of highlighting the risks that could lead into a more severe recession, though we don't see that as a likely scenario. So some of our economic assumptions, I've walked through a little bit of this right now. We talked about the Fed, we talked about inflation. We don't believe there's systemic financial risk associated with the recent bank failures. We mentioned the federal government will avoid a debt limit breach. Seems like that's already happened now. Labor supply constraints will continue to ease, but elevated wage growth remains in place this year. We don't expect new variants of COVID to have any major impact. We don't expect the Russia-Ukraine conflict to expand beyond what it is. And as a result, there is no baseline recession in our numbers. But again, that may be semantics. And we believe that the bigger risk to recession is not 2023, but 2024. So just something to keep in mind there. So let's talk about what all that means to operating fundamentals. So talked about kind of all the macro data that shapes our outlook, for the different demand segments. This is our actual demand segment recovery projection. So a couple of things to highlight: corporate transient. Without people in the office 5 days a week, we don't think corporate transient recovers to pre-pandemic levels anytime soon. We estimate that in 2022, corporate transient demand was about 20% below 2019 levels. We forecast corporate transient demand to recover to about 10% below 2019 levels this year, which is largely where it's going to hold over the next few years. It will not get fully back. Now, if people aren't in the office as often as they were before, corporations are going to be looking for ways to get them together more frequently. You're going to see more, retreats and, in-house type events, as well as you're going to see more corporations choose to send more people to conferences and conventions for team building and things like that. So maybe instead of sending 5 of the people on the 10-person team, you send 7 or 8 to a given event. And that may be something that helps drive group demand in general. In 2021, group demand was about half of where it was in 2019. Last year it was about 15% below where it was in 2019. I think it's basically going to almost get all the way back to 2019 levels this year, and we expect it to stabilize about 10% above 2019 levels. Leisure's an interesting one. When you think about tourism, we saw this massive bounce coming out of the pandemic in terms of, leisure demand. It started to wane a little bit last year, but you were still really, really strong. We think that continues this year. We keep hearing nuggets that that's softening as well. But ultimately, we think leisure will stabilize in that 25 to 30% above where it was pre-pandemic. So in short, you're seeing some mix shift from pre-pandemic to current, where you're looking at corporate is giving up while group and leisure are strengthening relative to pre-pandemic. But relative to 2022, corporate is strengthening, group is strengthening, and leisure is waning. So your baseline really matters in terms of how you're thinking about that stuff. Let's move on to supply. Supply is kind of an interesting one. We expect supply to be very, very muted throughout the course of the next few years. We've got a 1.1% economic supply growth CAGR. Wouldn't be surprised if that comes in lower than that. To give you an idea, right now we incorporate all the hotel rooms that are, quote, out of inventory related to migrant housing, especially in a market like New York, where there's close to 25,000 of those hotel rooms. If we just took those rooms out of inventory today, our numbers would drop by, just in New York, just from the rooms out in New York, would drop well below 1%. So some perspective here, there's some noise in supply growth. I know STR and CoStar have come out with some pretty muted supply numbers. We don't really disagree with their numbers, which a lot of it comes down to the timing of when hotels are going to open throughout the year and how you're allocating some of those hotels that are temporarily offline. For our purposes in this analysis, we're assuming those hotels remain online and as part of inventory, but to the extent that they drop out, that would have an impact and get our numbers much closer to theirs. But regardless, the numbers are incredibly muted. Here's our RevPAR model. One of the things that we do is we share kind of how our RevPAR model has historically back tested relative to the actual results. And that's what you see in this chart, 99% R squared. For those of you that don't know statistics, R squared is basically a measure of predictive accuracy. So we're highly accurate historically. Drivers of our model, as you see right here, unemployment rate, GDP. Again, GDP, one of those really soft metrics that we're talking about going forward, is a driver here. Business investment, which was negative in the first quarter, and we'll talk about that in a little bit. And then foreign exchange rates. Here's our ADR model, very similar, 98.7% R squared, but the drivers are a little different. Business investment, consumer confidence, unemployment rate, and inflation. And we put all that together to give you our current forecast. Bottom line for this year, we actually think RevPAR is going to be up 6.6%. So you may have been like, oh my God, Ryan, Lark is so negative. We've talked about all these headwinds that we see from the economy, but we're still looking at 6.6% RevPAR growth this year. Again, we are the highest across the industry right now. Keep in mind, RevPAR was up 16.7% in the first quarter. We also expect 2Q to be up less than 2%. So there's a lot of noise back and forth in terms of a lot of the metrics regarding RevPAR. At the end of the day, the massive growth that we saw coming out of the pandemic is behind us now, and now it's about some other factors. The other thing that I'll tell you, while we're the strongest this year in terms of RevPAR growth and ADR growth, we also going forward expect occupancy to stabilize well below where anybody else is. We don't think occupancy gets back to those prior peak levels, like some of the other forecasters out there do. The other thing is that all of our numbers, 2024 through 2027, have all come down since last quarter by an average of almost 1 percentage point of growth each year. 1 percentage point of growth. That is a meaningful pullback in absolute RevPAR when you look at 2027 versus now versus a quarter ago. And again, that's all tying to kind of that credit crunch, or at least, credit malaise that we're seeing across the markets today, that we think impacts economic growth over the next couple of years. Gives us a little bit more of a muted outlook beyond 2023, where we're a little bit more cautious. If we look at 2023 specifically, this is our quarterly breakdown for our quarterly RevPAR forecast. 2Q is only going to be up 1.3%. We expect it to be the weakest quarter of the year. It's driven by more difficult year-over-year leisure comparisons, especially related to soft comps, tough comps from the pent-up demand coming out of Omicron last year. Negative business investment in 1Q is going to weigh on corporate travel recovery. The debt ceiling's weighing on resolutions weighing on corporate travel in the second quarter. Excuse me. And generally sluggish economic growth will weigh on corporate travel in the second quarter. But based on mix shift, we actually have positive views in the third quarter, where we think a lot of leisure demand is going to be strong. It may move around a little bit in terms of markets and locations, but we're going to see a lot more international inbound demand to gateway cities that generally run at higher ADRs. And that's going to help fuel ADR growth across the country just by a mix shift into more demand into higher rated urban markets than we saw last year. That should be a positive for these metrics. So you may not see it on a like for like basis across a lot of hotels, but on a mixed basis across the country, it actually skews ADR favorably, which helps drive some of our numbers. And then beginning in 2020, in the fourth quarter is when we really start to see some of that economic malaise start to show up, and we start to see occupancy down slightly, ADR growth still doing okay, but you've got a really soft comp related to the Jewish holiday calendar shift in the fourth quarter that helps that, and then economic growth continues to wane, and it weighs on RevPAR looking into 2024 and beyond, as we just talked about. So let's talk about price classes. In 2023, growth shouldn't be too surprising. Strongest at the upper upscale and upscale segments. Think group demand, think improving corporate transient, think urban. That's where things are going to shine this year. Shouldn't be too surprising to anybody on this call. Luxury, we took a pretty big haircut to luxury based on what we're seeing in the data today, while the other segments at the lower end on a year-over-year basis we continue to expect pretty muted growth. If you look at the price classes relative to 2019 levels, luxury is still the strongest, followed by the lower end segments, while upper upscale and upscale, which are the two that are going to see the strongest year-over-year growth this year, are the weakest relative to 2019. Excuse me, too much talking this week with NYU and NAREIT. So when you think about our forecasts, one of the things that I'll highlight real quickly is we're firm believers in better data in equals better data out. So we focus on only using the best data providers that we can find. That's STR or CoStar for top line operating results, detailed economic forecasts from Moody's Analytics, citywide pacing data from local CVBs. Still amazed the other forecasters out there don't take into account convention center booking paces when they're forecasting for a given market or even the country. Hugely important data. And we track it very closely because we know how important it is. Office market health, we get that data from Moody's Analytics. Supply pipeline, we get that from a combination of Build Central and CoStar, and then we do a lot of work ourselves on that to get comfortable surrounding the supply outlook. Short-term rental data comes from AirDNA. Historical cap rate data comes from CoStar. And when you put, in our view, when you actually put better data into your models, you do get better data out. And fortunately, it has shown. This is our 2022 accuracy for RevPAR growth relative to the other primary prognosticators. We were by far the closest for occupancy, ADR, and RevPAR. Yes, we missed on RevPAR. We were a little light. We were higher than everybody else, though. And in December of 2021, we warned our clients in our client letter that we thought our ADR metrics may prove to be conservative because our models we didn't have confidence that our models fully accounted for the elevated level of inflation that we were going to see because we'd never seen it before. Excuse me. So if you think 2022 was an anomaly, it wasn't. There we were again in 2021, by far closer than everybody else. And we get the question all the time about how we stack up relative to other guys at the market level. Well, we only get data from other forecasts, from one other forecaster out there at the market level. And that one other forecaster, we are more accurate in 70% of the markets that we cover. And when we miss, they miss by an average of 1.9 times more at the RevPAR growth level than we do. So historically, we've proven to be more accurate at the market level as well. It shouldn't be too surprising when you see the national metrics. Excuse me. Let's move from top line to bottom line and value, right? So let's start with wages. Wage growth is high. We obviously saw the massive growth numbers in 2021. 2022 started to come down, but still really high. We think things are starting to come down. This is a forecast from Moody's Analytics for hotel industry wage growth, where we think they expect things to be pulling back pretty meaningfully by the end of this year. And overall, over the next few quarters, over the next few years, we're not seeing massive wage rate growth of 3.5% CAGR through 2027. That's positive, but you're not giving back any of the recent wage gains that have been experienced. Property taxes are also going to grow at relatively high levels at 4.9%. Other expenses will grow at inflation. And what that leads to is decent EBITDA growth this year and next year, followed by slightly negative EBITDA growth in the years that follow. But by next year, we expect hotel EBITDA to peak almost 10% above where we were in 2019. When we think about cap rates, some of you that have tuned into this webinar have seen this story before, but I think it's important to highlight to people. I actually had a great conversation with my counterparts at CoStar this week at NYU about cap rates and spreads, because I think we're all thinking about it similarly. And that really just comes down to the idea that hotel cap rates are a combination of some level of base rate and some level of spread over that base rate. We use the base rate as the 10-year treasury yield. That 10-year treasury yield is what you see in the dark columns here. And you can see a decent amount of volatility in it, whereas the cap rate data from CoStar is less volatile. And what's kind of interesting, if you look at on a rolling 4-quarter basis, the correlation between the 10-year treasury yield and cap rates is negative 2.4%, and the R square is 0.1%, effectively having no strong relationship whatsoever between the two. As one goes up, it doesn't impact the other, right? What's fascinating is if you look at, so why is that the case? What's driving it, and how does that make sense? If base rates are going up, why would cap rates not go up? Well, here's how you think about it historically. Historically, base rates move higher, the Fed's raising rates, bond yields are expanding in periods of relative economic confidence and growth, right? That's historically when we've seen bond yields expand, right? Because you've got to reach for yield. You don't have to reach for yield. You got confidence, all those fun things. And when you have positive economic outlooks, risk premia compress. And risk premium is another way to think about a spread for a cap rate versus a base rate. Flip side, when base rates are compressing, going down, it's because there's a ton of economic uncertainty. The Fed is lowering rates, trying to protect the economy. And that economic uncertainty and risk gets built into that spread, and that risk premium widens, right? Makes a ton of sense. So if you look back historically, we actually have a negative 97.6% correlation between the change in treasury yields and the change in spreads going back to 2000, and a 95.3% R squared. So historically, as interest rates go up, spreads come down. As interest rates go down, spreads go up. Therefore, interest rates don't have that impact on cap rates. What's fascinating is they go up and down by almost the exact same amount. If you look at the 10-year, you look at the inverted spread versus the 10-year, you can see they move not just in conjunction with one another, but almost at the same level. It's pretty staggering. So that tells us that over time, if we have economic confidence and base rates will come in and spreads will narrow. Or base rates will stay high, but spreads will narrow. Or if we lose economic confidence, base rates will come in, but spreads will remain wide. And net, right now, what's unique about this period over the past 12 months versus the last 20 years of data that we have on cap rates and spreads is that we're in a period where we're seeing base rates expand while we have economic uncertainty. And it comes back to the trying to fight inflation, the reality of borrowing from the future to cover the pandemic, like we talked about earlier. All of that is playing out right now. But it will revert back to that mean relationship. And when it does, cap rates will stabilize and transactions will start to get done more frequently. But that's just something to keep an eye on, and just another way to think about where cap rates should ultimately go, because at the end of the day, we generally have a relatively stable view of cap rates moving forward. We don't think cap rates are expanding much or compressing much going forward. Relatively safe. So our US forecast summary, I touched upon a good chunk of this already, but bottom line here is we expect values to be up about 5% this year. Over the next 3 years, they're only up about 3% on an annualized basis, and then less than 2% looking out 5 years. But net values are still positive over the next 5 years versus where we were in 2022, and that should be encouraging to a lot of investors. When you think about how our forecast changed for 2023, we generally got slightly more positive at the top line. It's nominal. We've been hovering around 6.5% RevPAR growth since last fall for this year. It hasn't really changed much. But our outlook for wages, for expenses increased, and that let our EBITDA down a little bit. And that led our values to erode slightly from where we were a quarter ago. When we talk about the value recovery, right now, we've talked about where we were leading up to 2023, with values effectively being just slightly below 2019 levels last year. We expect the US values to exceed 2019 levels this year, and exceed the peak of the last cycle which was 2018. Next year, 2024. However, we also think that's probably the peak of this cycle from a value perspective, and it's just 4% above 2018 levels. Going beyond 2024, we have modest declines in cash flows, which really drives that value to stabilized / slightly decline going forward. So let's talk about markets. I know you guys want to talk about markets. I know everybody's excited about what markets do we like, which ones do we not. This is a list of our market coverage. We issue standard reports on 34 markets. We do revenue-focused reports on another 16. And later this month, we're adding 9 more. So we will be at 59 markets issuing reports on a quarterly basis by the end of June. So if anybody's interested in any reports, just let us know. We certainly have them. Think about our market coverage. Before we jump into market coverage, I want to go back to that GDP versus RevPAR discussion. So if you go back 2000 to 2019, the relationship between GDP and demand and RevPAR was incredibly high. 78% correlations with demand and GDP, 79% with RevPAR. R squareds both over 60%. That correlation was, and R squareds were even higher since the pandemic, because you weren't getting any international inbound demand or any international outbound demand during the pandemic. That relationship will start to moderate going forward as international is a bigger component. But from that perspective, you can see there's a very strong relationship between GDP at the national level and lodging demand and RevPAR at the national level. Unfortunately, at the local level, that relationship has largely broken down. If you look at since 2019, the correlation was just 42% with an R squared of just 18%, effectively meaning that those two things don't really move together. We've got a lot of markets where economic growth was strong and RevPAR was negative, or markets where RevPAR is strong and actually economic growth is negative, right? You've got both of these things going on over the past 3 years that have led to a correlation that's just 1% in an R squared of 0 over the past 3 years. Understanding kind of what we call this new normal, and the reality of new normal is there's no relationship. The long term is there will be some relationship, but it's far more limited than what you get and what you see from the US overall, and not something to rely on. So don't really rely on, hey, this market has the strongest economic growth, I want to invest there. You have to understand what really drives a given market. What are the demand drivers in a given market? In New York, it's obviously financial services, economic output. Houston, we care about energy. LA, you care about the entertainment industry. Miami, you're looking at foreign exchange rates. You're looking at factors that drive leisure demand. all these different things. Every market is not driven by the same factors. And understanding the nuances of what drives each individual market is what will lead you to make an informed decision about a given market. And that's the work that we generally do, which gets us to our views on the markets. But there's this data related to RevPAR. It looks almost the same related to demand, right? Again, totally broken down. 11% R squared since 2019, 18% overall. So again, just gets back to my point. So as we think about market forecasts going forward, here's how we look at market. Here's our outlook for given markets. Top chart here shows, excuse me, RevPAR growth in 2023 versus 2022 by market. What you will notice is that a lot of the markets that are at the top in 2023 versus 2022 are markets that have experienced some of the weakest RevPAR growth through 2022 coming out of the pandemic. San Francisco, DC, San Jose, Houston, Chicago, et cetera. And the markets down here that have some of the weakest growth relative to 2022 are the markets that have experienced robust growth prior to through 2022. Miami, Puerto Rico, Mobile, New Orleans, San Diego, Palm Beach, et cetera. And then if you look at 2023 versus 2019, those markets over here are still the top ones. Palm Beach, Tampa, Puerto Rico, Mobile, Miami, all up there at the top. And those markets over here at the top on a year-over-year basis are still towards the bottom here. There's San Francisco, San Jose, Minneapolis. You get the idea. What your baseline is really matters. So if we take a longer term view and say, let's take a look at the next 5 years. Again, some of these markets that have struggled to recover will be some of the stronger markets that didn't have as much difficulty recovering early on will be some of the weaker markets. We'll highlight Austin here. Austin's kind of an interesting one, which screens as one of our worst RevPAR growth markets over the next 5 years. The convention center is going under the knife next year. It's going to be basically, I don't want to say shut down, but drastically limited for the next 4 years. That's going to have a huge impact on that market. Just something to keep in mind as you think about Austin. It's something that we've been following pretty closely. We now have a high degree of certainty that that's happening. And then if you look at 2027 versus 2019, which is the bottom chart, you'll see again, some of those markets that were strong through 2022 remain particularly strong over the long term. Heavy leisure orientation here from Palm Beach to Mobile to Puerto Rico, Las Vegas, Memphis, Anaheim, Tampa, Orlando, Miami, Phoenix, Norfolk, Honolulu as our top markets for RevPAR growth relative to 2019. And then the markets that are at the bottom tend to be some of those markets that have struggled to recover, and we think will continue to struggle to recover. Moving beyond RevPAR, you've got, we take a look at all the factors from hotel EBITDA to cap rate spreads to get you to value metrics. And as we do that, what you'll see is two different metrics here. One is 27 versus 22, and the other is 27 versus 2019. Some of the strongest growth is going to be in markets like Minneapolis, Dallas, LA, Denver, Charlotte, Vegas over the next 5 years. We also really like Puerto Rico. San Francisco is going to see real growth over the next 5 years. Unfortunately, relative to 2019, it's still way below where we think 2019 was. So it's kind of like a resetting of that base. Expectations had to come in for San Francisco. Hopefully they have come in now, and values are getting more reasonable. That being said, our top markets, relative to 2019, Puerto Rico, Tampa, Nashville, Las Vegas, Miami, we like them all very, very much. Also really like Phoenix and Dallas. They all screen really well. One market I'll highlight is Los Angeles right here. In April of 2023, the LA City Council, proposed to increase the minimum wage for all tourism workers by 40%. Tourism workers includes airport workers and all hotel workers. We expect that proposal to pass. As that proposal passes, you will see a big increase in wage growth in wages. And as we see that increase in wages, it is going to have an impact on cash flows and values. So prior to that announcement, Los Angeles was in our top 5, and now it has slipped down here, just from the expectation that the minimum wage is going to be reset materially higher. With that gives you a good overview of our markets. Now, I think before before we go to Q&A, I really want to highlight to people some things that we've got going on with what we call our Lark GIS tool, which will enable you to go down from the market level to the real location level within a given market. And I'm really excited to announce that in about a month, we're going to be rolling out RevPAR forecasts on an annual basis, great for budgeting season, for 217,000 census block groups across the US. Take a look and get a sense of what I mean as I play this brief video. Maybe. Here it goes.
We proudly introduce Lark GIS, a revolutionary tool for hotel underwriting, the first of its kind GIS tool to quantify the quality of any hotel location. A geographic information system, GIS, is a technological tool that creates, manages, analyzes, and maps all types of data. GIS connects data to a map, integrating location data with valuable descriptive information. Whether you are a developer, investor, lender, franchisor, or manager, understanding the value of a given location for a hotel use is critical to positioning a property and investment for success. GIS systems have been used across other property types for decades to determine the best locations for new developments or investment. But until now, data tied to hotel demand drivers were hard to come by in GIS tools. Well, not anymore. Lark GIS is focused exclusively on the hotel industry, featuring macroeconomic factors that are key indicators for hotel demand, like economic activity, retail sales, and office employment. We incorporated data for every hotel and every hotel under construction, as well as the meeting space from over 40,000 hotels and 400 convention centers to measure proximity to meeting demand. We estimate annual visitation levels to 27 categories of leisure demand driver, including beaches, ski areas, golf courses, amusement parks, theaters, museums, zoos, and many more. We also model RevPAR data down to the block group level, all with predictive 5-year forecast data included. All this data is available to view, analyze, and download on an inventory-adjusted basis. The best part is the Lark score, a proprietary metric that quantifies all this data into one simple metric, broken down into corporate, leisure, and group scores. Lark GIS has plenty of other functionality. Easily compare a specific hotel to see how its location matches up with competitors in the market. You can even evaluate development sites and compare those locations to existing hotels. Determine what you believe the trade area from which a hotel draws demand and pull data specific to that area. Compare up to 8 locations or assets at a time. All this data is then easily downloaded. We can also run queries to identify target assets based on specific criteria. Additionally, the tool includes vehicle traffic data and satellite views, all conveniently at your fingertips. Lark GIS is truly a revolutionary tool for hotel underwriting. Contact Lark for a demonstration and a free trial now.
All right, we're pretty excited about what we've got going on with Lark GIS. Like I mentioned, annual RevPAR forecast, a little bit different. We're pretty excited about it. And I think most of our clients have been very excited about it. We are going to host a live demo next week, I think Thursday at 1 p.m. And I have just now posted a link to register for that demo if you're interested in learning more about Lark GIS, which we think is going to really change how hotels are underwritten. That being said, we're going to go ahead and jump into our market review. So US market review. Okay, I'm not sure what happened there. Hopefully not everybody heard all of that, but I did. Anyway, Lark GIS, we're really excited about what's happening with that. Like I mentioned, we're going to add consensus or census block group RevPAR focus forecasts for every hotel in the country, basically every census block group, looking annually 5 years. It should be out in about a month, along with a few other things. And here's our standard pricing for our reports to the extent anybody is interested. If you want to learn more about any of the reports or any of or Lark GIS, just reach out. We're happy to help you. And with that, I'd like to introduce Anatol. Anatol is Lark's summer intern from Boston University. He's going to spearhead our Q&A session. So Anatol, why don't you tell me what we got?
Alrighty, so we'll start with a question on the demand segment recovery numbers that you presented at the beginning. The question specifically is if the numbers are in revenues or in room nights.
Room nights, not revenues. Yes, there's the chart. That is a demand. So it's based on room nights.
The next question was asking specific to New York. Can you give some more details on numbers of rooms being used for migrant and homeless housing? How much that has grown since 2019, and how that potentially impacts supply going forward as well. As in, are they going to be taken out of supply fully or just for the time being?
So these are great questions, and I don't know all the answers. It's actually really fascinating, and I spent a lot of time talking with the SDR guys about it this week at NYU because we all are really fascinated by what's happening here. My estimates, which aren't dissimilar to what you might hear from SDR or CoStar, is that today there's somewhere in the ballpark of 25 to 30,000 hotel rooms that are out of inventory related to migrant housing and homelessness. Prior to the pandemic, it was somewhere in the 5 to 10,000 room level that was really focused on homeless. There wasn't much from a migrant housing perspective. What's interesting about the migrant housing dynamic is it's related to asylum seekers that are in New York. The city is funding it, paying exorbitant prices, or I shouldn't say exorbitant, but paying elevated ADRs, entering what would appear to be relatively long-term deals. We're hearing about a handful of them. Some range from 18 months to some all the way out to 4 years. But we're also hearing that in most cases, the city has a 30-day termination clause. So it's unclear whether these rooms are going to stay out of inventory for a month or 4 years. And the reality is, there's going to be a point, because it's migrant housing, where the hotel owners aren't managing these properties, aren't maintaining them, aren't putting the capital in. And at what point do these hotels need a total gut renovation before they can become hotels again? In some cases, many of them needed that total gut renovation before they became migrant housing. Just take a look at the Roosevelt, which was expected to be permanently closed and now is reopened as migrant housing. But it's not just the Roosevelt. You've got branded hotels. The Holiday Inn Financial District downtown, 400-room Holiday Inn is migrant housing. You got the Row NYC, 1,000 rooms in Times Square. These are meaningful properties. It's unclear how long they're going to stay out of inventory, but my guess is if they are out of inventory for 6 months, they will stay out of inventory for a heck of a lot longer than that because of the amount of capital it's going to require to get them back to inventory. And that's a meaningful number, 25 to 30,000 rooms, of which roughly 20 to 25,000 are migrant. New York City in general has around 135,000 hotel rooms. So, we're talking, a meaningful number, 15 to 20% of total inventory is likely out. With that, next question, Anatol.
So how much of the post-COVID extraordinary ADR growth is attributed to the fiscal and monetary stimulus and resulting inflation? And how do you see ADR going forward in the event of material recession generally, and in lodging specifically? Does it revert closer to pre-COVID trends, or are the gains experienced post-COVID here to stay? In other words, just to summarize the question a little bit, is the Fed's mission to kill inflation, do they also kill hotel ADRs as well?
That's a good question. I think that in short, in raising rates and essentially stagnating economic growth is going to limit ADR growth pretty meaningfully. Our outlook for ADR nationally is that it's going to remain positive over the next 5 years. So we don't see ADR turning negative. But we do see very, very muted growth starting in 2025. So I think that probably answers your question. It's very hard to bifurcate what component of ADR was driven by fiscal stimulus, because then you have to break down, well, what did fiscal stimulus drive across the broader economy that drove ADR and all these other things. These things tend to move, a lot of isolating those things are very challenging, but it definitely had an impact coming out of the pandemic. And you certainly saw it drive substantial ADR growth in a lot of leisure-oriented markets. And when you think about some of those leisure-oriented markets that saw really strong ADR growth, they're seeing a pullback right now. And we expected that, and we continue to expect that, but we also don't think that will stay that way permanently. We think this is just kind of a step back followed by more growth down the road. I'll stop there. Next question.
The next question is asking if insurance costs are growing at the rate of inflation.
Oh, definitely not. Insurance costs are growing well above inflation. We've heard massive increases, in some cases double as insurance contracts come up for renewal. So be very careful about some of those.
The next question is asking about the cost for GIS tool in total.
I'd say circle up with us offline. GIS is a progressive pricing model. It's based on the user, the developer that's got, a handful of hotels and maybe looking to do a deal a year is going to get pricing that will be able for that developer to stomach, whereas the guy who's got 500 hotels and has a programmatic development program of 30 hotels a year is going to pay a lot more. As you can imagine, it's just the use case. So circle up, reach out to us if you want to learn more. We're happy to walk you through it.
The next question says that we shared the 2023 outlook for demand by segment. What's the outlook for corporate, group, and leisure ADRs year over year?
We don't break down corporate, group, and leisure ADRs because we don't get good enough metrics on it. As you guys all know, when you think about the segmentation metrics, it is very difficult to ascertain. Our segmentation data, to give you guys some understanding of how we get there, we look at a handful of factors. We look at, number one, booking channels, which we think is important, but it's not the end all be all. I know there are a lot of people that were in town this week for the NYU Hotel Conference that did not stay at the Marriott Marquis, and their and their stay at whatever hotel they were at probably went down as a corporate transient booking channel, but they were there for a group convention. So we start with the booking channels. We don't end with the booking channels. We then look at day of week stayed, knowing that especially with the quote bleisure, the launch of leisure travel, that there is a combination. If you're staying overnight, you're staying over a weekend, you're likely to have a few days of leisure and a few days of business. We also look at that day of week to see what conventions are in-house, to give us a sense of, or in market at that point in time, to give us a sense of whether there's a significant amount of convention demand that maybe isn't being registered by specific booking channels. And then we also look at length of stay and the market, knowing that certain markets are more inclined to have leisure demand for midweek than other markets. And so we look at all of those factors, and then we triangulate and give our best estimate from a demand mix perspective. But it's very hard to do it from a demand mix perspective and from an ADR perspective, so we don't even try. So I don't have a great answer for you. What I can tell you is that this year we know group is strong, and pricing on group has been pretty positive. Corporate transient on a year-over-year growth rate has been good, and will likely continue to be good. Leisure is going to face much more challenges on a year-over-year growth rate, largely because leisure had such high ADRs, especially in leisure-oriented markets. Think beach towns and the like, ski resorts, etc. That mountain resorts over the summer that are facing pullback from those ADR levels.
The next question is asking what specifically is driving the outperformance in Mobile.
It's a leisure market. It's the beaches. It's really what it comes down to. Drive to beach destination.
Awesome. The next question states, with hotel values projected to grow under 3% across the next 5 years, what does the landscape look like for acquisitions through the end of this year and into next year? The tightening of the lending market and continued rises in wages and expense inflation is going to erode GOP, not to mention insurance costs rising immensely as well. With that in mind, who becomes the primary investor and what does the hold period look like?
Yeah, that's a mouthful of a question, a good one. Look, I think you know, if I wish I had that crystal ball really well. I think it's hard to know. Our views where we think things are going is we're optimistic that over the course of the summer, the Fed is going to continue to not raise rates. But the economic growth is going to continue to have a tremendous amount of risk and uncertainty tied to it, as credit continues to tighten. And when I say credit, I'm not talking about hotel debt or real estate debt. I'm talking about broader credit, which is a much bigger issue than, you know, hotel debt, which is such a tiny component of broader credit. That's going to weigh on, we think that's going to weigh on economic growth. You know, we think debt will be available. Debt's available today for hotels. People just don't like the pricing of it. I think that as the market gets more comfortable with the Fed stabilizing things, and hotel fundamentals perform relatively well throughout the summer and into the fall, you're going to see spread compression for the for hotel debt. You know, cost of debt, and as you see that spread compression for cost of debt, you're going to see more and more deals pencil out. I would argue that the buyers best positioned in that environment are those that don't necessarily need to raise debt to fund their acquisitions. They can always put capital on later, if they so choose, or not choose. But they are few and far between and aren't always the most aggressive buyers. So it remains to be seen who's going to step up and, you know, be more aggressive. What you got next, Dental? Yeah.
The next question says that outside of the top 50 markets, any specific ones that stand out as outperformers for the next 5 years?
You know, I don't want to opine on markets that we don't track on a super close basis. We do a lot of you know, custom consulting work on specific markets, and there are certainly some that we like, but without having really spent a lot of time on them, I don't want to add more commentary beyond those 50. Wait, Anatole, I can't hear you.
Can you hear me now? Is this better?
Yes, yes.
Sorry. What have been the sales per key trends since COVID? And do we have separate data separating performance by segments, luxury versus full, select, extended stay, along those lines?
Yeah, extended stay is a weird one. We don't have great data on extended stay because it blends into the full, select, luxury. You know, we do have data on that. It's not, we don't forecast for the price classes for hotel EBITDA and cash flows. But feel free to reach out. Really the best data provider for data like that is really going to be CoStar, though.
Okay. Next question asks why Houston is soft compared to Dallas or Atlanta.
It's a good question. So Dallas has stronger economic growth than Houston. Houston isn't a market that we dislike longer term, but it has faced a challenging recovery, and a lot of it has come down to the energy markets haven't recovered back to where they were 10 years ago at anywhere near the pace that I think we started to think they were going to a couple years ago, based on where oil prices had gone, and then oil prices pulled back, and the war in Ukraine has had some impact on some of those types of things. So I think there's a lot of moving pieces there, but at the end of the day, Houston, even though it's a diversified market, is still heavily exposed to the energy markets, and the energy markets haven't seen the growth that we might have expected a couple years ago, and haven't seen a recovery from where they were, you know, 10 years ago or 7 years ago, which is still weighing on that broader market. But it's not a market we dislike, and we just don't like it nearly as much as a market like Dallas.
Okay. And last question that I have is, what is the outlook for international demand inbound into the United States?
Looking good. Low bar, right? We didn't see much international inbound demand last year, so we're seeing a nice snapback, but there's a long way to go. Visa issues will remain a challenge that will limit things, but we're going to see a big snapback this summer from Asia, especially to the West Coast, which will be an encouraging sign for some of those West Coast markets that are really dependent on some of that international inbound Asian travel, which is encouraging. Those markets have been slower to recover, so that will be a nice injection that they really need. but there's still a long way to go. And I don't think international inbound is going to be overly aggressive over the next over the next 12 months, but is going to continue to recover. That would not get back to 2019 levels anytime soon. The good news is, based on the outlook for foreign exchange rates with the dollar weakening, every year the US is going to get cheaper and cheaper for foreign travelers to come here, and more expensive for domestic travelers to go abroad. And that is relatively encouraging for year-on-year growth. Is that it, Anatol?
That's the last question I have.
All right, everybody. Well, thank you so much for taking the time. I hope you enjoyed the webinar. As I mentioned, we'll shoot out the slide deck tomorrow, as well as a link to this recording if you have any questions. And then if you need to reach out to us for anything, please don't hesitate. You can reach out. Information at larkanalytics.com is the easiest way to get a hold of us. Or you can try me myself. Thanks for taking the time. I hope you found it helpful. Have a great day.